Hi everyone and welcome back to the channel. I'm Eric. I'm a financial advisor and retirement income specialist. Have you ever worried about running out of money in retirement? If so, you're not alone. In fact, it's a concern that I hear from nearly every client that I work with. In this video, I'm going to combine two powerful approaches: the wisdom of Bill Bengen, creator of the famous 4% rule, and a segmented time-weighted income method to help you build a reliable plan for your retirement. Running out of money is the number one retirement fear. Why? Well, people are living longer, healthcare costs are rising, and market ups and downs can destroy decades of savings if we're not prepared. So how do we design a plan that gives you peace of mind, one that actually lasts as long as you do? Well, there's so many options and ways and opinions, strategies from fiduciaries, financial advisors, planners, tax guys, insurance agents, TV personalities, financial influencers, stockbrokers, and on when it comes to taking money out of your retirement accounts and helping you make that money last. The reality is, you have to be the ultimate decision maker and decide what's right for you and your goals. What I want to do in this video is show you what's been working and is working for our clients, why it works, and how you can use it in retirement. So let's first talk about what's the right withdrawal rate. And a lot of times people say, can I just live off the growth and maintain the principal? People like Dave Ramsey says you can take out 8%. Bill Bengen updated his advice and now recommends around 5%. Susie Orman says you should take out no more than 3%. Well, who's right? The answer is there's no one-size-fits-all solution. There are so many factors that go into the decision, including your appetite for risk, your financial situation, your health, your life expectancy, and so on and so on. Well, I want to have a quick conversation on the withdrawal rates. And there's this concept called the 4% rule. Back in the 1990s, an advisor by the name of Bill Bengen created what became known in our industry as the 4% rule. In theory, you could safely withdraw 4% of your portfolio in your first year of retirement, increase withdrawals with inflation, and then historically, you wouldn't run out of money over a 30-year span. And he wasn't wrong. But times have changed, and so has the research. In a recent interview with Yahoo Finance, Mr. Bengen said that his research is more sophisticated. In 1994, I was looking at a portfolio with two investments, U.S. bonds and large U.S. company stocks. Well, that hardly qualifies as a diversified portfolio. As you increase the number of assets, you increase the withdrawal rates, and I suspect it will probably peak somewhere around 5% when you add in all the other assets. He further explained that he hasn't looked at gold, precious metals, commodities, real estate investments, and other alternative investments. There are a lot of other things that folks can invest in and do invest in. I think there's a pretty good chance that adding some of those to your portfolio will further enhance your withdrawal rates, assuming you get the performance out of the investments. Well, the key word is assuming. And the concept is still based on probability of your money lasting. The problem is no one knows how long you're going to live. No one knows what the markets are going to do. Are they going to be up? Are they going to be down? No one has that crystal ball. So think about this. Would you jump on a plane if the pilot said, folks, welcome on board, just to let you know that we have about a 78% chance of landing our plane to our destination? Well, how many of you would jump on that plane? Probably none of us. You want those odds as high as possible. Retirement income planning is the same thing. You want those odds as high as you can. In the same interview, the reporter asked, can you talk a little bit about someone who's retiring into an uncertain economic environment, whether it's high inflation or a bear market? Bill Bengen responded, my research shows that if early in retirement you encounter a bear market or a sustained high inflation, your withdrawal rates are going to drop quite significantly. If there's anything you can do to avoid that in terms of timing your retirement, it'd be a good idea. See, Bill Bengen is making the case to avoid the risk of bad timing when it comes to retirement distributions in the early part of your retirement picture. This is where a time-weighted, segmented income approach comes into play. First, let's talk about the core of this strategy, and it's about segmenting your retirement into time buckets. It's nothing new. It's been around for a long time, but let's expand on this concept and see if we can make it better when it comes to helping make the money that you've worked hard for last the rest of your life. And here's how a segmented income approach works. First, we want to take a look at the first 5 years. In our practice, we use investments like fixed annuities that are backed by the claims paying ability of an insurance company. There are no surprises. There's no stock market headaches. You always know where your paycheck is coming from. Now, in years 6 through 10, we want moderate, predictable growth. Here we look for a balanced mix of investments that have little growth, but low to no risk. CDs, multi-year guaranteed annuities, are great places for this segment. And then in years 11 and beyond, this is where growth and compounding take the lead. This portion can be invested for long-term growth. Now, think diversified stock funds and mutual funds. Why? Because markets reward patience and long time frames. It's the let it grow without dabbing into it for a long time asset. This approach means that you're never forced to sell investments in a panic, and it matches your assets to your income needs year by year. So what makes this work? There are 3 things why I think this works really well. The first is diversification. Bengen's research and industry leaders like Fidelity and Vanguard show that the more diversified your investments, the higher and safer your withdrawal rate can be. And when they talk about diversification, they're not just talking about stocks and bonds. They're also talking about alternatives, real estate, annuities, and using the many various financial instruments that are at your disposal to optimize the most amount of income for your retirement so that you can live your best life forward. The second part is based on predictability and not hope. When you were working, did you desire a paycheck that was based on predictability or probability, certainty or hope, reliability or potential? So why should your retirement income be any different? Studies from BlackRock, TIA, Fidelity, and Vanguard all say the same thing. Don't leave your retirement up to chance. Predictable income streams like a time segment approach help reduce anxiety and lead to better outcomes. And then the third is the flexibility. Markets go up and markets go down. Inflation can bite. But by reviewing your plan each year and adjusting as needed, this is going to allow you to stay on track. And then there's the ultimate secret weapon, and it's called compounding. According to Standard & Poor's and FactSet, over a rolling 10-year period, the U.S. stock market has rewarded patient investors with strong average returns. The key isn't trying to time the market, it's about time in the market. Let's bring it all together and see how this plays out. And I'm going to use a client example. Imagine a client has $1 million at retirement, and they need about $50,000 per year. So in the first 5 years, you're going to carve out $250,000 in that income bucket. The next $250,000 is positioned for moderate growth from years 6 through 10, and it's carefully managed with inflation being aware. And then the remaining $500,000, that's going to be allocated for growth, giving it time to recover from any volatility and benefit from long-term market gains. We're going to let that grow for the next 10 years. Here's where things get really powerful. Every 5 years, you want to revisit your plan. And now we want to ladder forward, meaning as each 5-year income block is spent, we review your portfolio and ask, can we buy another 5 years of secure cash flow? Well, this keeps you laddering forward, creating a next 10-year cushion and giving the remaining part of your portfolio more time to grow. Now, sometimes you've done a great job of saving, or you're spending well within your means, or the markets have an explosion of growth. So instead of only 5 years, we might carve out 10 years of reliable income at once, on top of the 5 years that's already built in. Or even a better example, once you've secured income for your first decade, maybe you can take a chunk and create a lifetime guaranteed income stream, an annuity stream designed to last as long as you do. So your income never runs out and you never have to sell in a panic. The remaining balance of your portfolio is freed up to keep growing for the next 15, 20, 30, maybe even 40 years. So think about what that could mean for your portfolio. This becomes your opportunity fund for big expenses, life adventures, or unexpected costs like long-term care. And instead of drawing 4, 5, or 8% of your portfolio, you're only drawing maybe 1 or 2% from the opportunity fund that has the potential to keep getting bigger every year. The biggest advantage is you're never just hoping for the best. You always know where the next decade or plus of income is coming from, with flexibility to adapt as your needs change. With this setup and using updated withdrawal research, you can often draw more than the old 4% with more confidence. Now, we never take a one-size-fits-all approach. These numbers are specific to your needs and your personalized situation. What's the bottom line? The old 4% rule isn't dead, but it's evolving. Research shows that you can often withdraw more if you diversify and segment your income carefully. Predictability, diversification, and compounding are your friends. Hope and guesswork, take that out the door. The best plan is customized for you, built with the most up-to-date research and adjusted as your life changes. Hope you found this video helpful. If you want help mapping out your own segmented, evidence-based retirement plan, book a call with me today. Let's make sure your nest egg lasts as long as you do. And it also gives you the freedom to enjoy the retirement on your own terms. Thanks for watching. Subscribe for more retirement strategies and see you next time.